Welcome to the next depreciation method video. In this video, we're going to look at the alternate optional straight line method. We have two methods that are approved by the IRS. One is called the Maker's method. That's a modified accelerated cost recovery system. And the other one is the alternate optional straight line method. So let's take a look at an exercise and see how we're going to work through with this. Francis Corporation purchased an asset at a cost of $50,000 on March 1st, 2017. The asset has a useful life of 8 years and salvage value is $4,000. For tax purposes, the optional straight line method is used. The maker's class life is 5 years. We've been asked to calculate the depreciation expense for each of the years from 2017 through 2022. That's a total of 6 years. So to start with, as we're looking at the depreciation expense for tax purposes, we ignore the useful life of the asset and we ignore the salvage value of the asset. These two pieces of information are irrelevant for calculating depreciation expense for tax purposes. They are relevant for the business, but not for calculating the depreciation expense. So what's the relevant information that we need? So I'm going to pull out all the relevant information over here. Our relevant information is the acquisition date. It's March 1st, 2017. The original cost is $50,000. The depreciation base is $50,000. We're ignoring salvage value. The estimated useful life again is ignored. What I'm concerned with is the maker's life of 5 years. If the maker's life is 5 years, the recovery is going to be over a 6-year period. So I set up my table over here with the headings. I have the 6-year period from 2017 through 2022. My depreciation base is $50,000. That's going to stay the same all the way through. The rate of depreciation, I'll show you that calculation in a second. Once I have that, doing the last step is going to be easy. So let's see how we're going to calculate the rate of depreciation. The rate of depreciation we have is the straight line method. The rate of depreciation is 1 divided by life. In this case, 1 divided by life is 5 years. And I will calculate that to be 20%. 1 over 5 equals 20%. Now, in the first year, I'm going to calculate the depreciation only at 50%. The reason we are doing this is the IRS assumes that regardless of when you purchase the asset, you are not able to use it for the full 12 months in the first year. Typically, an asset, even if it happened to be purchased on January 1st, these are large assets we're talking about. It takes time for you to set up the asset, do all the test runs, make everything is okay, assure everything is okay before you actually start using it. So the assumption is you used it only for half a year. So the first year, the rate is going to be 10%. The following years, our rates are going to be at 20%. Now, in order for me to come up with the full 100%, in the last year, I have another 10%, which is why that 6th year is added. The first year I used it only for 6 months, which means the last 6 months goes into the 6th year. So the depreciation base multiplied by the relevant rate will give me the depreciation expense. So it's $5,000 for the first year. Subsequent years, it's $10,000. And then again, in the last year, it's $5,000. When you add up the numbers, you will get $50,000 because that's a depreciation base. That's the amount I was trying to depreciate. My journal entries are very straightforward over here. Depreciation expense debit, accumulated depreciation credit, and I know what the amounts are. The first year, it's $5,000. The next 4 years, it's $10,000. And then in the 6th year, it's going to be $5,000. So once again, just keep this in mind. If you're told that you're using the optional straight line method, the useful life of the asset and the salvage value need to be ignored. What is relevant is the original cost of the asset and the maker's life. The maker's life, we add 1 year for the cost recovery. The straight line method, 1 divided by life gives you the rate. For the first year and the last year, it's going to be half the amount. It's going to be only, in this case, 10%. Everything else is fairly straightforward in terms of how we do our calculations. So we have, once again, two methods that the IRS approves. One is a maker's method, and the second one is the optional straight line method. Either of those are acceptable for tax purposes.